Good. So topic number 10, standard costing and variances. It is there in CPA syllabus. It is not there in ATD. But now, this is the worst part of it. At ATD level, when you complete your ATD and you now transition to CPA, you will be exempted. You will be exempted, right? You will be exempted the whole of foundation level. You'll be exempted the whole of foundation level. But when you now get to advanced, intermediate level, intermediate, and advanced level, CPA intermediate and CPA advanced level, there is no exemption, right? No exemption. That is what is there. And for your information, management accounting is at intermediate level for CPA. And when I get to advanced level, I'm having advanced management accounting. So at CPA level intermediate, this is topic number 10. When I get to advanced level, it has been combined and it is now found in topic number 7. What does it tell you? If you don't attend this class as an ATD student, you'll be forced to attend management accounting class at intermediate level so that you can get this concept under topic number 7. Then you also find it at advanced level covered into details under topic number 7. That is budgetary control. It has been combined with topic number 10, but at CPA intermediate, it is topic number 10, variances being discussed independently. So having said that, you can now decide what to do with that information, whether to remain in the class or exit the class and wait for it at intermediate level. Good. So when you talk about standard cost, is basically, initially it was combined with the budgetary control. It was combined with budget, right? So you have to come up with estimates, build up a budget, then look at your actual results. Then the actual results were to be compared with the budget to check whether you've actually incurred the exact amount that was budgeted, you've incurred less, or you've incurred more than what you actually budgeted for. So for you to get the variance, for you to get the difference between actual results and budgeted results, then it means the two must be there. That is budgeted results and actual results. Now, with that information, when we get to topic number 10, we are talking about standard cost or standard costing. Standard costing is basically a budget, right? Maybe you've looked at the performance of the company over the last 5 years, over the last 10 years, over the last 72 months. Then from that, you get the average of each expense, and then automatically you'll come up with a pattern to help you get the budget for that particular month or year. Then once you have the budget, you will now start executing this budget. If you say you're going to purchase 100 kgs of material B, you look at what you're going to spend for the entire month or for the entire year. So once you're done with that particular duration, you now sit down and ask yourself, what was my budget in terms of kgs for this material? What is my actual expenditure in terms of kg for this particular material? Right? Remember, your budget will include quantity and price. At some point, you'll find that the quantity is actually utilized the way it was budgeted. But now, the total cost will change. Why? The selling price or the purchase price as per the budget is different from the purchase price as per the actual results. And therefore, you will still experience what we call variance. So that variance will be as a result of difference in selling price, not as a result of difference in quantity utilized. So that's what you're going to do here. Now, what are the components of standard cost? That's what I want us to get to understand before we get to variances. So standard cost cut. standard cost card, we are having estimates. So the first item you're going to have in the standard cost card, remember it is cost card, right? So we're talking about direct material, direct labor, variable production, overhead, variable production overhead, fixed production overhead, right? Then of course we'll be talking about total production cost, total production cost. So direct material plus direct labor, these two will give us what we call direct or prime cost. This will give us what we call prime cost. Then to the prime cost, we add variable production overhead, right? So these two added together will give us what we call prime cost. Or alternatively, we can decide to do it this way. Alternatively, we can decide to do it this way. So direct material plus direct labor will give us prime cost. To the prime cost, we need to add variable production overhead to give us now marginal cost, right? Marginal cost. To the marginal cost, when we add fixed production, overhead, we'll be talking about full production cost. We will be talking about full production cost. And I believe you've interacted with this concept at some point, possibly under topic number 7. Possibly under topic number 7. So are we together up to that point? Are we together up to that point? Are we together up to that point? Let me just take care of the visibility of our board. Great. Now, I want us to, I've also shared with you, a summary of past paper questions under this topic. I've shared with you a summary of past paper questions from this particular topic. So have you been able to access that summary? Have you been able to access that summary? I want us to see if we can use it to take care of something here. Have you been able to access the summary? We should be having a question. Is it August 2022, May 20? There's one where you are required to come up. It should be April 2022. Let's see what is there under April 2022. Let's see what is there under April 2022. April 2022. Are we able to see something there? You are told to prepare standard cost card. You are told to prepare cost card somewhere there. Cost card, April 2022. Do you have something of that kind anywhere? Do you have anything like that? Question 5. Which sitting is that? Which sitting? Lynette, which sitting? April 2022. Okay. So we should get to that place very fast. April 2022 CPA. Sorry, not. Faith has identified it. Which sitting? Faith? Faith to Saidia Apple, which sitting? April 2022. Question number 1, Biwacha tuone. Thank you. That is it. That's what I was looking for. So April 2022. April 2022. Question number 1B, CPA. CPA, that is the question I was looking for. Good. So let's look at what is there. We are being told that, let's see, at this point, you should be able to answer all the questions. So don't skip now the theory questions at this point. Number 1A, we are told that cost accounting uses information provided by financial accounting together with other details of internal operations of an organization. With reference to the above statement, describe the 3 similarities between cost accounting and financial accounting. What are some of the similarities? Topic number 1. Similarities between financial accounting and cost accounting. Similarities. Both of them depend on the financial data of the organization, right? Both of them depend on the financial data of the organization. The only difference is some are dependent on the historical data, while others are, okay, they're objective, right? So the only difference is how you're going to use this particular data. Are we preparing what has passed, or we are preparing what will be used in the future? That's the only difference, but all of them depends on financial data. Use numeric. That's now the financial data we're talking about. Right? We have these notes under topic number 1, na nilipeana notes zote. So watu wasome vizuri, watu wasome. Yeah, they are both used in decision making, right? Because you'll be told, you'll be told that management, accounting, or cost accounting information are used in decision making. We can actually get the users of this information. Number 1, we have board of directors. We have, of course, employees. That is now being used, or management, right? Internally, management accounting is normally used. Management accounting report is normally used internally. What about financial accounting report? Of course, if they are public company, they normally find them there are published financial statements, right? So the published financial statement, number 1, are normally published for the use by, right, customers. We have customers. We have lenders. Right? We have government for taxation and, of course, control of activities taking place within the organization. We have employees. We have shareholders, right? They want to get return for their investment, or even put more money into that particular business. That will only be possible if they use this. Use G, generally accepted accounting principles. That will be used when you now get to the differences. Remember, not both of them are using that. So in short, I'm trying to tell you that please go to your notes under topic 1 and look at the similarities and differences between cost accounting. Initially it was called cost accounting, but of course it's a branch of management accounting. Cost accounting and financial financial accounting. Are you able to identify the differences and similarities, right? Something of that kind. Or of course, at that point, don't forget about importance of studying management accounting or applications of management accounting in a business environment. So such kind of things, please go to topic number 1 and you'll be able to understand everything there. Back to question number 1B. Rengo Limited has provided the following data for the financial year 2022. So we have budgeted output for the year. We have standard details for 1 unit. Direct material, it requires 40 square meters at 530 per square meter. Direct labor is divided into 2. We have the direct labor incurred in the bonding cost center and of course, finishing cost center. So the finishing cost center and bonding cost center, we are given 48 hours at 250 per hour, 30 hours at 190 per hour. Remember, that is the cost incurred to produce 1 unit, the standard cost card for per unit. But the budgeted output is 9,800. So as per their budget, assuming that their budget is at optimal level, our total labor cost or material will be multiplied by 9,800. Then number 3, budgeted cost and hours per annum are also given there. Variable overheads, we are having hours 500,000 and the shillings are given there. Finishing cost center, we are also given something there. Then fixed overheads, we are having production, fixed overheads. We are having selling and distribution, fixed overheads. We are having administrative or administration cost, fixed overheads. What are you required to do? Number 1, prepare a standard cost statement of a unit cost showing number 1, prime cost. Number 2, variable production cost. Number 3, total cost. Number 4, selling price per unit at a notional profit of 15% on cost. What is the other name of this 15%? What is the other name of this 15%? Someone who has attended a FAR class will tell us what it means. Someone who has attended financial accounting class will tell us what this 15% means. Let us get the specific name. Let us get the specific name. Let us get the specific name. Markup, right? So markup is subject to cost of sales, while margin is subject to sales. Don't confuse the two, because when you get to advanced management accounting level, sasa tutapatana na what we call performance, strategic performance measurement and financial performance measurement methods. We are going to apply those ratios. So don't forget about them. Ensure you revise the ratios or understand what they mean. So we are required to get prime cost. We are required to get what we call prime cost. So what are the components of prime cost? What are the components of prime cost? Kindly repeat. Which part should I repeat? Which part should I repeat? Haya, andika hii mahali. Over cost of sales. Then margin is equal to profit over sales. If in a question they have started with markup, that is to say, if you are told that markup is equal to A over B, then your margin must have a bigger denominator. So it will be A over A plus B, or B plus A, or B plus A if you are given markup. If I want to get back to markup and I've been given margin and I have been given margin as A over B, then it means my markup will be equal to, so remember markup must have a lower denominator, so it will be equal to A over B minus A. Over B minus A. Good. So someone who is doing financial reporting, this semester, when you get to group accounts, there's something you normally deal with called, you call it UPS. Some people call it URP on stock. Some people call it unrealized profit on stock. Some people call it URP. Then now you mention stock or non-current assets. Right? It is normally used so much in FR when dealing with UPS on inventory, non-current assets, right? Such kind of things. Not part of what we need here in totality, but let's see. So our prime cost, we must consider direct material. Direct material. Good. What is the value of direct material? Direct material, are being told that direct materials, 40 square meters at 530 per square meter for 1 unit. And they intend to, or their budget indicates or talks about 9,800 units. So we have two ways. We can take the 40 square meters per unit, multiply by 9,800 units, right? To give us total square meters needed. And then you multiply by cost per square meter. And then you multiply by cost per square meter. Yeah. Alternatively, you can talk about direct material required per unit is 40 at 40 square meters at 530. That is for 1 unit. But we want standard cost card for how many units? We're talking about the 9,800 units. So once we have that in place, we multiply by 9,800 units. Tunapata ngapi hapa total? Total ni ngapi? But they wanted unit cost. Wanataka unit cost ama ngapi? Wacha tuone. Prepare standard cost statement of a unit cost showing. Okay. There's somewhere we are supposed to deal with all the units, but that's okay. There's some questions you'll be given and you cannot get per unit first. You'll have to get for all units and then come backward to per unit. So we can start from this point, get all the prime cost component for the 9,800 units, then we divide by 9,800 units. Alternatively, we can just get per unit up to the variable cost component. The variable cost components are the prime cost plus variable production overhead. When I get to fixed costs, I must get the cost driver. I believe when I talk about cost driver at this level, you understand what I mean. When I talk about overhead absorption rate at this level, you understand what? You understand what I mean. Thank you. So we can decide to get for the 9,800 units or just leave it at this point. So it means we are dealing with the standard cost card or prime cost for 1 unit. Now, what normally happens again as we progress, the standard cost card is not normally separated into prime cost, variable cost, the way we see it there. No, it is normally a continuous statement. But here they decided to split them into those sections, right? So we'll be able to see our next question, how it goes. So let's have 40 by 530. Let's take unit wise. 40 by 530, 21. 21,200. Good. Then we go to direct labor. Direct labor is divided into two. We have bonding, cost center, and finishing. So we have bonding and finishing. Finishing cost center. Good. Now, bonding cost center, we are told that they're supposed to use 48 hours per unit, right? 48 hours per unit at what price per unit per hour? 250. Then this one here is 30 hours at 190. So let's start with the first one. Let's start with the first one. That is 48 at 250 tunapata ngapi? 48 at 250 tunapata ngapi? Thank you for that. So how are we going to deal with that? Somebody to help us get that. Somebody to help us get that. Trials. Any trial? Overhead absorption rate. So which one will be our cost driver? We use the overhead absorption rate. We're supposed to get this cost per unit, but remember, these costs are absorbed based on, labor. I mean, based on hours. But you're supposed to get the cost per unit. How are you going to address that? How are you going to address that? Overhead absorption rate times hours taken per unit. So what you're going to do here, we all know that the total cost given here, yes, the overhead absorption rate is hours, but the total cost that was incurred corresponds to how many units? 9,800 units. So please just go ahead and take that total overhead under bonding center, divide by 9,800 units. So what will you have here? What will you have there? If you divide, what will you have? $382. Somebody's getting 382.65. Okay. Divide by 9,800 units. Tunachukua total cost, which is it 37.50? We are dividing by 9,800. So that will give us 382.65. Okay. 382.6. So you can see you started rounding off at this early stage. So as you progress, that rounding off will affect most of things, but you can decide to get the total cost, then divide by units at the very last end. Good. How about finishing? What will we have? Finishing department, variable cost is 1,500,000. We divide by 9,800. Tunapata ngapi? Yes, 1,500 divide by 9,800. Watu wameshindwa kufanya hesabu. 153.06. Good. So we have prime cost, then the variable cost are these ones here, right? The prime cost, then we add the variable cost. So total variable cost. Total variable cost. Total variable cost. Not just variable, but ensure you include the word variable production cost. Tutakuwa na ngapi? Total variable production cost. Yes, 339,435. 39,435.71. That's our variable production cost. Then to the variable production cost, we bring in fixed production overheads, which in most cases you'll find that they are normally absorbed based on the number of units. So let's look at the fixed production. Fixed production overheads. Do we have the cost driver anywhere? Have they mentioned the cost driver anywhere? They have not. So we are going to take that divided by the number of units. 39,200,000 divided by 9,800. Tunapata ngapi? We aren't using the 500,000 anywhere. The 500,000, if you are to get cost per hour, right? If you are to get overhead absorption rate, then you multiply by actual activity level. If you talk about overheads absorbed, then you have to go this route, right? Remember, actual activity level here is hours, but these hours here, what we are getting is per unit. It is not absorbed based on units. It is absorbed based on hours. So the two cannot go together. That's why we are taking the entire amount, dividing by the number of units as per the budget for the entire year. Good. What are we getting? What are we getting? I think tumekosea. Which part? Jeff, which part? Kwa variable cost. Variable cost, we have under bonding cost center, we have 3750 divided by 9,800. Give me the answer. Then 1,500 divide by 9,800. Give me the answer. If the answers are 382, I mean, if they're different from this, then please let me know. If they are different from these figures, please then let me know. Let me know, Jeff and any other person. What is the budgeted units? I hope sasa tunakosea hapo kidogo. How many units are supposed to be produced as per this budget? Budgeted units ni ngapi? Hapo ndio tunakosea. Budgeted units ni ngapi for the entire year? Budgeted production. Budgeted production ni ngapi? Sasa mbona mtu anaweka 9,800,000 here? Hiyo ingine imetoka wapi? We are dividing by the number of units. This is for the entire year for the budgeted units. What if we take 37 divided by 500,000, then we get 7.5 shillings per hour. Then we multiply by 48 hours for bonding per unit. Have they said so? Have they said so? Wamesema kitu kama hiyo? Now, what you need to understand is what we are having here is as per the budget. What we are having there is as per the budget. So as per the budget, these figures will not change. What we are trying to do is just make sure that we get cost per unit. Remember what we are talking about. If you are given standards here, then you are told to get overheads absorbed. Remember, I'm now taking you to the portion of topic number 7, specifically absorption costing. Absorption costing. Right? So absorption costing, you're going to look at how the overheads are being absorbed into the production process. Right? Now, what you are preparing here is per unit. Is it making sense to somebody? Is it making sense to somebody? Thank you. Good. So somebody saying that where are we getting 4,000 from? Tumesema fixed production overheads. Tumepewa ngapi? Fixed production overheads tumepewa 19 million or 39,200,000. We are supposed to divide this by 9,800,000 or 9,800 to give us the fixed overhead per unit. Tunapata ngapi? If we are doing it for all the units, we were to pick the figures and put here the way they are. We were to take that 3750, put it here. We were to take 1500, put it here. We were to take 39,200, put it here, and get all the costs for the 9,800 units. Don't combine the two. I wish tungelewana hapa hivi. So what you can do, put standard cost card per unit. Standard cost card per unit. What we are putting here is the cost incurred per unit. When you go that direction, you are going to talk about overheads absorbed into the production process. That will now apply when we get to comparing standard costs and actual results. Actual results, we normally absorb the expenses based on the cost driver. So under that, we'll have to consider the suitable cost driver, which we have been told is the hours. Tunaelewana hapo, Faith? Yeah. Good. So what are you getting when you divide this? 4,000. So I believe somebody was asking about the 4,000. Your question is now answered. Good. Then from the fixed production overheads, when I bring in total variable production cost and I add to fixed production overhead, I'll be getting what we call full cost. Full production cost. So talk about full production cost. So what are you getting? Is it 40 what? 43. Is it 43,435.71? 43,435.71? Good. Now, these are the production costs. Look at the question. Were you required to get only total production cost or total costs? There's a very big difference between total production cost and total cost. When you are told total cost, any expense incurred, whether it is production or non-production, it will be part of this. But if you are told to give us only total production cost, then you have to stop at this point. What were you required to calculate? Total cost. So to the total production cost, we need to bring in the non-production costs. So let me come to this point. Because of space, I'll just transfer my full production cost, which is 43 435.71, right? Then to that, we bring in now the non-production expenses. We have fixed selling and distribution. So we have fixed selling and distribution, which normally depends on the units that have been sold, but you can see, then we have fixed administration costs. So let's get this one here. Per unit itakuwa ngapi? Per unit, when you take 19,600,000 divided by 9,800, tunapata ngapi? 2,000. When we take 9,800,000 divided by 9,800, tunapata ngapi? 1,000. When you add everything, we are going to talk about total cost. Total cost. Itakuwa ngapi? Total costs. Total cost itakuwa ngapi? Total cost. 46. Please repeat. Which part are we not getting? Which part should I repeat? Eddie, which part should I repeat? Last part is not specific. Which one? Admin cost. Fixed production and selling, tunachukua 19,600,000. We divide by 9,800 units. Then 9,800,000. We divide by 9,800. Hapa nimeambiwa inaleta 2,000. Hapa nimeambiwa inaleta 1,000. That's what I've added. This 43, whatever, is the continuation of this part. Ni 2, I was not able to put all of them there because I want to extend some things down here. Good. Are we together? Are we together? Are we together? 46, 3, 46, 3, 435, 46, 435.71. 46, 435.71. Good. That is the total cost per unit. Standard cost card per unit. That is the total cost per unit. If you try to take this total cost per unit, multiply by 9,800, you are going to get total cost for all the 9,800 units. Now, to this total cost, what are they telling us? They want us to get the selling price per unit. Selling price per unit in a notion profit of 15% on cost. So that is markup. Profit markup. Ningapi? 15% of how much? Of 46. 435.71. Tunapata ngapi? Profit markup ni ngapi? Profit markup ni ngapi? Profit markup. Profit markup, profit markup. 15% of 15% of that itakuwa ngapi? $69.65. .3736. Are we getting 69.65.36? Are we getting 60? Good. So can you add all that? When you add, you are talking about selling. Talking about selling price. Selling price itakuwa ngapi? Selling price per unit. Now that all these costs are per unit. Budgeted selling price. Budgeted selling price. Budgeted selling price itakuwa ngapi? Budgeted selling price 5341.07. $5341.07. Is that what we are getting? Is that what we are getting? What is 15% coming? Where is it coming from? Mtu wa mjibu. Mtu wa mjibu. Somebody to respond to that. We have answered that question cumulatively. Look at Roman 1, prime cost. Roman 2, variable production cost. Roman 3, total cost. Roman 4, selling price per unit at a notion profit of 15% on cost. That is the origin of this 15%. So the answer to Roman 1 of the question, this is it. The answer to Roman 2 of the question, variable production cost, ziko hapa. The variable production cost is basically prime cost plus any other variable production overhead. So there are only those two, total variable production cost. So this is Roman 3, Roman 2 of our question. Roman 3, we are told to get total cost, not full production cost, no, total cost. That is why to the full production cost, we add the non-production cost. That is fixed selling and distribution, has got nothing to do with production. Fixed administration cost, it has got nothing to do with production, to give us the answer to Roman 3 of our question. Then the last part, we are being told to get selling price per unit. Selling price per unit. Yeah. So that's what we are required to do. Do fixed costs depend on the number of units produced? Do fixed costs depend on the number of units produced? It depends with the question. If you are told that the cost driver is the number of units, that is what you're going to do. If you are told that the cost driver is the labor hours, that is what you do. Actually, in this topic, we are going to address that. Good, so let's go to variances. There's nothing under standard cost card that you're going to discuss beyond this. This is it. Ukielewa hii part, you are good to go. You'll be able to now deal with the variances. So let's go to variances. Do you need a break? Do you feel like we need to have a break? If no, then of course we move directly to variances. If yes, we'll just do as usual. Do you think we need a break? Okay, you can have your 5 minutes break. So let's meet at 7:12. Great. So question number 4B, we are being told here that Q Limited, is it Q? Q Limited manufactures a single product branded Q. The product is product Q. The standard selling price and variable cost per unit of product Q are as follows. The standard, the budgeted activities. Selling price is given as 136 shillings per unit of Q. Material, 2 kgs at 10 shillings per kilogram, which means the company is going to spend 20 shillings to produce a unit of Q. Then labor, 3 hours at 24 shillings per direct labor hour. Additional information, the budgeted sales for the month of October 2015 were 38,000 units. The actual results for the month of October 2015 were as follows. Actual production and sales, 36,000 units. Selling price per unit, 134. That is the actual, but their budget was indicating 136. Then material, they purchased 76,000 kilograms at a cost of 754,000. Labor costs, they utilized 114,000 labor hours that was paid at a cost of 26.56 hours, shillings. The company operates a standard costing system and a just-in-time purchasing and production system. So just-in-time is basically where the company does not keep any closing inventory. If the customer comes to the shop and say, please give me 1,000 units, then the company says, you are going to receive that in 1 week time, in 2 days time. They don't keep any stock. They only produce based on what is demanded. That is the just-in-time purchasing system. Required, showing applicable variances, prepare statement that reconciles the budgeted contribution with the actual contribution for the month of October 2015. The budgeted contribution and actual contribution. Why are they talking about contribution? Tulisema vizuri that for us to get contribution, it is selling price minus variable production cost. Right? Minus variable production cost. When you deduct, so in this question, the only variable production costs are material and labor cost. So instead of telling you net profit, they are not talking about net profit, because when you talk about net profit, fixed cost must appear somewhere. It is not there in this question. So that's why they are stopping at contribution. So let's now move with speed and list these formulas. As we handle the question, we'll be talking about the formulas. So we only have three. We only have three variances where when you get a negative, you say it is positive. When you get a positive, you say it is negative. And you'll be able to see them here. Now, let's start with the selling price. Let's start with the selling price. We need to address all the variances. We need to address all the variances. That is what we need to deal with here. That is what we need to deal with here. Good. So selling price variance. Selling price variance is equal to, remember selling price variance, we are going to look at the cause of change or difference in the sales. And one of the causes is maybe the difference in the selling price and also difference in the volume of goods sold. So let's start with this. It means you're going to look at the standard selling price compared with actual selling price. Then this we multiply by actual quantity sold. Actual quantity sold. All right, good. So let's come to this part. Standard selling price. What was the standard or budgeted selling price per unit? What was the budgeted selling price per unit? Budgeted selling price per unit iko wapi? How much is it? How much is it? Watu wamesahau, watu wamepotea tena. Additional information number, is it the first statement? So they are as follows. The standard selling price, 136. 136. Now, what was the actual selling price per unit? Actual selling price per unit. Remember, you are dealing with the selling price, not quantity. 134. Now, what you need to understand is, when dealing with these questions, this is the simplest topic. If you are to get A in management accounting, then this topic will be one of the topics that will be contributing to that. What I need to understand is the formula. In layman's language, when you come to this part, selling price, that is cash inflow. That is revenue we are talking about, right? That is revenue we are talking about. As per your budget, ulisema vizuri, I'll be selling this product at 134. Then you ended up selling this product actually at 136, and you ended up receiving only 134 per unit that was sold. Are you talking about profits or losses? Are you talking about profit or losses? It is going to be a loss. But if you get the difference between these two, what will you have? You'll get a positive number, right? If you get the difference between the two, you'll get a positive number. But now, sitting down and trying to think logically, when you plan to receive revenue of 136 per unit, and you end up getting 134 per unit, that is a lost revenue. So that is adverse variance. Even though the figure will be positive, but we take the reverse. Thank you. Now, whatever is in the bracket will determine whether you're going to indicate adverse or favorable. So always focus on the bracket and look at what you have within the bracket. So what was the actual quantity sold? Actual quantity sold? Actual quantity sold, 36,000 units. The difference between these two is 2 shillings. So when we take 2 multiplied by 36,000, what are you getting? 72,000. 72,000 and verse. Thank you. That is it. There's nothing complex about it. Just like that. Let's go to the second one. Under revenue, your revenue can reduce as a result of two things. Number one, change in the selling price or change in the quantity sold. Or change in the quantity sold. So let's look at how quantity sold will affect our revenue. So quantity sold, we are talking about sales margin volume variance. Sales margin volume variance. So sales margin volume variance will be equal to standard quantity minus actual quantity or volume. Volume is the same as quantity. Then we multiply by standard margin. We multiply by standard. We multiply by standard margin. We multiply by standard. We multiply by standard margin. Good. So let's look at it from this point. What was the budgeted sales in terms of units? What was the budgeted? Hey. Say itachukua space. Then it means we have to do this. Standard selling price. Actual selling price. Actual quantity sold. Sales. So that was sales margin volume variance. SQ standard quantity sold. AQ actual quantity sold. Then STD margin standard margin. Good. So let's get standard quantity sold. Standard quantity sold. Standard quantity as per their budget. How many units were to be produced and sold? 38,000. They planned to produce and sell 38,000. They ended up selling how many units? 36,000 units. Before we go to the standard margin, that will come later. This one here is the answer. This we are going to get whether it is adverse or favorable. So you planned to sell 38,000. You ended up selling only 36,000. The difference will be a positive yes. Is it adverse or favorable? Is it adverse or favorable variance? Is it adverse or favorable variance? Adverse. Thank you. Good. So the next thing is the standard margin. How do we get margin without the word standard? How do we normally get profit margin? Margin is equal to selling price. Is equal to selling price minus variable production cost. Tumefanya sahi, right? Margin is equal to selling price minus variable production cost. So let's start with the selling price. As per the standard, remember we are talking about standard margin. So if I bring in the word standard margin, it will be standard selling price minus standard variable production cost. What was the standard selling price? Tunaitoa hapa juu. Standard selling price 136. Minus variable production cost, we have direct material, we have direct labor, right? And that variable production overhead if it is there. Good. So what is the variable production overhead? Let's start with direct material. What was the cost of direct material per unit as per the standard? Cost of direct material per unit as per the standard? 20. Minus labor. What was the labor cost per unit? Labor cost per unit? 72. So that will give us standard margin. Standard margin ni ngapi? Standard margin ni ngapi? 44. That's what we bring here. That's what we bring here, the standard margin. So the difference between these two is 2,000 multiplied by 44. Tunapata ngapi? Tunapata ngapi? 2,000. 2,000. 2,000. 88,000. 88,000 adverse. That is our special variance number 2, that you take the reverse. Yes, the answer will be a positive, but you take the reverse. That is variance, special variance number 1, special variance number 2. The other one, we are going to get it under expenses. So on the revenue side, this is what we are going to deal with. This is what we normally deal with on the revenue side. Good. Now, let me see. Okay, we'll get to that. Remember, what's happening is this. Under this part, we are assuming it is in this class that we did what we tackled topic number 7, marginal and absorption costing. I want to inform you that under this topic number 10, marginal and absorption costing will come into place. The costing method being used by the company will determine how you're going to deal with this section here and the fixed overheads variances. For example, if the company was using fixed or absorption costing, then it would have been standard fixed cost per unit, right? Or standard profit per unit. Remember, net profit now, or net profit or gross profit per unit is now when you bring in all the fixed costs, the fixed production cost as part of the production cost. Good. So once you're done with those two, let's get to the expenses side. On the expenses side, we are going to start with material. We get to labor, we get to variable production overheads as we progress. Good. So let's start with material price variance. So number 3, it is not special. If you get a negative, that is it. If you get a positive, that is it. That's why I'm not adding the word S to our variance number 3. It is not a special variance. you transfer what you will be able to, what you get is what you transfer. But the first two, they are special. If I get a positive, I indicate negative. If I get a negative, I indicate positive. For example, if this was to be 40,000, 38 minus 40 will give me negative of 2,000. But in real sense, I planned to sell 38 and I ended up selling 40,000 units. I've made more revenue. I've been able to sell 2,000 extra units. So the extra units will give me a positive figure. It will be favorable, not adverse. If I get a negative, I indicate favorable. If I get a positive, I indicate adverse. I believe that is perfectly explained. Material price variance is equal to standard price minus actual price, then multiplied by actual quantity of raw material. Actual quantity of raw material. Actual quantity of raw material. Right? So let me just do away with that. When dealing with material now, so standard, that is standard purchase price, of course, for raw material, then AP actual purchase price, not actual selling price. Then we have actual quantity, that is actual quantity purchased. Good. Back to our question. What was the standard purchase price per unit of raw material? Standard purchase price per unit of raw material? Standard purchase price per unit of raw material ni ngapi? Ni ngapi? Kila mtu aweke answer tuone hapo. Now let us look at it. Thank you. You've actually answered my question. I now have a very simple task ahead. Now look at that question. We are told that materials, they are going to use 2 kgs, which was to be purchased at 10 shillings per kg. So 1 unit of Q, 1 unit of finished product Q requires 2 kgs. But 1 kg of this raw material is supposed to be purchased at 10 shillings. So it means the cost of raw material to produce a unit of Q is 20 shillings. But the cost of purchasing 1 kg of the material is not 20 shillings. So how much is that? How much is that? It is 10 shillings. Right? Standard price of raw material of 1 unit of raw material is 10 shillings. But the cost of raw material to purchase a unit of finished product Q is 20 shillings. So what we are required to put here is the standard purchase price per unit of raw material, which is 10 shillings. Good. How about actual price of raw material? Actual price of raw material ni ngapi? So we go to additional information number 2. Actual results for the month of October were as follows. Let's go to material. They purchased 76,000 kgs and the company paid 754,000 to purchase 76,000 kgs. That will give us the purchase price per unit of raw material. We multiply by actual quantity of raw material, which is 76,000 kgs. I am trying to bring something. So let's first of all deal with this first portion. Kindly repeat on the part of 10 shillings. 1 kg of material is equal to shillings, 10 shillings. But 1 unit of product Q is equal to 2 kgs of material. So how much are we going to spend to be able to produce 1 unit of product Q? So material cost per unit of Q will be 2 kgs multiplied by the purchase price per kg, which is 10 shillings. So that will give us 20. Now, in the question under standard costs, you are given 20 shillings. But the description is 2 kgs of material at 10 shillings per kg. What we are putting here is the standard price per kg or per unit of measure. If it was liters, standard price per liter. Good. What you have given me there, I've actually answered my question. What normally happens is, in most cases, if not all, you will find that when I want to get actual price per unit, I'll be getting decimal places. That I can confirm to you that in most questions, you'll be having, for example, 754,000. When you divide by 76,000, you'll be getting a decimal. In most cases, for example, in this case, you are getting 9.921. I want to confirm to you that examiners are normally harsh when we get to variances. They normally stick to exact answer. They don't have that option of plus or minus. They normally ignore that. That is not available under this topic. So how do we help ourselves get all these free marks? Look at it. I'm told to take this, right? 754 total cost divided by kgs to give me 9.921. Then at the end of it, I need to multiply by 76,000. So can somebody just give me this? Let's say you have decided to round off this to 9.9. Can you take 9.9 by 76,000? What will you have? 9.9 by 76,000. What will you have? What will you have? What our to me calculator vizuri? 752,400. And what were we having initially? 754,000. So have you seen the problem of rounding off? Have you seen the problem of rounding off? How do I do away with this rounding off? It is very simple. What I will do in my calculator, I will just take this to divide, right? And of course, we have been able to see it is 9.921. Of course, we have something here. Is rounded off too much. It will be maybe to 4 or 5. Now, if you look at this, we compare it with 10. That is what you need to do. Just look at it, then compare it with 10. They budgeted to purchase raw material at 10 shillings per kg, but they ended up spending 9.9 per kg of the same material. Have they saved some money, or they have spent more than what they budgeted for? We are not talking about expenses. For income, we need to maximize, right? For expenses, we need to minimize. So when you end up spending less than what you budgeted to spend, what have you done? You have been able to save some money. So even if I'm going to take the whole day moving through to get these other items, for sure, I know my answer must have the word favorable, right? I'll take the whole day struggling with all this that is here, but before I do anything, I've now known that difference between 10 and 9, I've saved some amount, being that this is an expense. So I'm talking about favorable. My answer must have the word favorable. Anything else will come later, but I must recognize that my answer will have the word favorable. Good. Now, if I take this, divide by 76,000, then I multiply by the same 76,000. See, I will retain the same number. Then how about 10? I will take 10 times 76,000. Then the difference will give me that exact answer. Now, in your calculator, don't round off. In your calculator, just go to your calculator, put in bracket 754 divided by 76,000. Right? You'll get the answer. So that answer will help you to identify whether you've saved or you've spent more than what you budgeted for. Once you know that, just take 10 minus that your answer. 9.92, maybe 7, 9, all that, right? Vile equal, just take 10 minus answer. Whatever you are having, don't round off. Now multiply by 76,000. I can assure you, you will have a whole number. And if you followed that, please give me your whole number, which will be favorable. 6,000 favorable. Sijui kama tunaelewana. Are we moving together? Are we moving together? Thank you. Good. Let's go to number 4. Number 4 is not a special variance. Number 4 is not a special variance. Now, when you're going to purchase your raw material, two things will come into place. You can get the variance because of number 1, the cost of purchasing this raw material. That can lead to variance because you plan to spend 10, you ended up spending 9.9. So that has already cost the variance. Number 2, assuming that the purchase price was the same, another factor will affect material variance. Another factor will help us or will make us get material variance. What is this other factor? The quantity of raw material you are going to use in the production will also make you have variances if it is not equal to what you budgeted for. So then it means we are coming to material usage variance, which is equal to standard quantity of material in actual production minus actual quantity of raw material. Then we multiply by standard price of raw material. At this level, you cannot tell us, remember what we have been given in the question is the standard cost card for 1 unit. Is the standard cost card for producing a unit of product Q. But you now find in the actual production, they produced 36,000 units. So we must get standard quantity in actual production. We compare with actual quantity. Then you multiply by standard price. Yeah, that is it. Somebody saying that my board is not clear. Does it apply to everyone? Are you able to see my board from your side? Because just check on your network. So MUV is equal to material usage variance. So when dealing with raw material, SQ is standard quantity, right? Standard quantity of raw material. Then actual quantity of raw material. Then SP, standard price of raw material. Good, so let's come to this part. As per the budget, what was the standard quantity of raw material per unit of product Q? What was the budgeted quantity of raw material per unit of product Q? It was 2 kgs, right? So we are going to take 2 kgs of raw material as per the standard per unit of product Q. We multiply by actual production. Remember, we don't produce raw material. We are producing finished product Q. So what is the actual production of product Q? 36,000. then we less actual quantity of raw material. What was the actual quantity of raw material? Or what is the actual quantity of raw material? 76,000. Then we need to multiply by standard price of raw material. Tulitumia hapa juu. Good. So what are we getting? 2 by 36, that is 72,000. So just look at it from this side, 72,000. We are comparing with 76,000. Then you multiply by 10. Before we get to the actual answer, are we talking about favorable or adverse? Is it favorable or adverse variance? Is it favorable or adverse variance? Ulitenga or ulipanga kutumia 72,000 kgs and you ended up using 76,000 kgs. Remember, this is an expense. So are we talking about saving, or you've exceeded what you're actually supposed to use? It is an adverse. Thank you. So if it's an adverse, I don't need to struggle. What I now need to do is to go ahead and get the difference between 76 and 72. That is 4,000. 4,000 by 10 will give me 40,000. Will give me 40,000. Just like that. Remember, I told that this is the simplest topic. This is the simplest. This is the simplest topic. Where did we get 76? This 76 imetoka wapi? Angalia formula. Actual quantity of raw material. Now, Claire, what is additional information number 2 telling us about the quantity of raw material? What is additional information number 2 telling us about the quantity of raw material that was actually utilized in the production of the 36,000 units? What is the quantity? Somebody to help us there. 76,000. Is your question answered? Thank you. Grace, what's your question? So we only need to understand the form. Yes, I told you this topic. If you have the formulas, you don't even need to struggle. You don't even need to struggle. Good. So let's go to the next part. Now we have been able to see how raw material can have variances, right? Number 1, we look at the price, we look at the quantity used. If we now get to, remember there are those goods whereby you need more than one raw material, right? You need maybe material A, material B, material C, and the quantity of material A used will affect the quantity of material B used in the production of that product. Now, under those cases, we're talking about material mix variance, material yield variance, right? We're talking about those things. We'll be able to see them here. Number 2, if you are told to give us material cost variance, material cost variance is the material price variance plus material usage variance. So when you add these two, your result will be called material cost variance. So we have a positive of 6,000, a negative of 40,000, which means our material cost variance will be 30 what? Will be 34,000 adverse. Good. So let's get to labor. Let's get to labor. So talking about labor rate variance. You don't buy labor, but you pay for the services, right? You don't buy labor, but you pay for the service. That's why you don't call it labor price variance. No, it is now rate. At what rate are you going to pay for the services? So labor rate variance is equal to standard rate minus actual rate. Then we multiply by actual hours. Labor rate variance is equal to standard rate minus actual rate divided by actual hours. If it is before Since 𝗂𝗃𝑚 on R1 can approach question 1C on the same. Question 1C under the same topic. Okay, we'll see. But now we have 5 minutes to go. We have 5 minutes to go. We have 5 minutes to go. We'll be able to see if that time will allow us. Good. So labor rate variance, standard rate, actual hours. So let's get to this part. What was the standard rate? Remember, labor is paid for based on hours. So what was the labor rate per hour? Labor rate per hour. How much is being paid to those who are offering the services per hour? How much is the labor rate per hour? We have 3 hours required to produce this product, but the rate is 24 shillings per. The rate is 24 shillings per what? Per hour. The rate is 24 shillings per hour. That is the labor rate. Rate, we are talking about money. Actual rate. How much was the actual rate? We are not given that actual rate, but we are given total or actual amount paid. Actual amount paid. It is 56,000, right? That is what was paid as the labor cost. And labor hours is 14,000. This will give us the actual rate per hour, right? So that we multiply by actual hours, which is 114,000. 114,000. Good. Somebody's getting 23. Okay, 23 point something, 23.23. Sasa utajiuliza, if you are to pay 24 shillings, but imepunguzwa kidogo, sasa unalipa 23. Is it something you should be happy about, or there's a problem? You should be happy about it because you've saved some amount. The moment you've been able to see that you've saved, it is favorable. So I'm just waiting for your answer. What I know, it is favorable. So 24 minus this. Okay, angalia vizuri, this divided by this one here, multiply by the same thing to retain E. So just take this times this one minus 2656. Tunapata ngapi? 80,000 favorable. 80,000 favorable. Good. Then we move to the next one. Labor rate. Even though you can pay for that labor, yes, lakini hapa watu wanapiga story. You will get someone, amefika kazini 8 a.m., right? 8 a.m. Lakini lazima asalimie watu 30 minutes. Huyu ni yule wa kusalimia kila mtu kwa ofisi. 30 minutes amesalimia watu, right? Ameanza kazi. Ikifika 12:30, ameenda early lunch break. Na hiyo 12:30 anarudi saa 8, right? Anafaa chukue 1 hour, amechukua time ya kampuni, another 30 minutes extra, hajafanya kazi, right? Ikifika jioni, they're supposed to leave at 5, lakini ikifika 4:30, yeye ali switch off kitambo, anangoja hiyo 5 ifike aende nyumbani. So 30 minutes before time, pia hajafanya kazi. Sasa huyu mtu, you have paid him or her 1 hour, 30 minutes. Hiyo umemlipa na hajafanya kazi, right? Lakini wewe unahesabu anafanya kazi from 8 a.m. to 5 p.m. So what you have paid for is this number of hours. And you are trying to compare it with the number of units they have produced. But actual hours used in the production is not this interval, no. It is this interval less 1 hour, 30 minutes. Now, it means we have to go ahead and look at what we call labor efficiency variance. How effective is it that the labor paid for is converted into production? How effective is that? So labor efficiency variance, standard hours in actual production minus actual hours multiplied by standard rate. That is what we need to take care of. Okay, somebody saying that they have a class, not at 1 minute haijapita. Wow. Okay, so it means we have to stop. We have to stop. Thanks for your time. Have a blessed night and let's meet on Friday.